Hi everyone, it's Simon here from Trend Trading 360. It's Sunday the 25th of March and I just want to provide you with a bit of a market update and prognosis. I was going to write another blog post today just talking about market action and where I think we're headed next, but I found that there were so many charts that I wanted to go over that video format was potentially going to be a lot more efficient and potentially enjoyable as well for all of us. So please let me know if you like the video format or not. But let's just get started with a quick analysis of the S&P 500. Now this is a chart of the SPY, which is the biggest ETF that tracks the S&P 500. Now the S&P 500 rallied into an all-time high here on the 26th of January and then suffered a pretty short, sharp correction down here, which I'm sure most of you probably still remember quite well, bottoming out on the 9th of February. And after bouncing here, pretty much all it's done since is bounce between these two fairly key Fibonacci levels. Let me just explain a little bit more about what's going on here. So I've drawn Fibonacci retracement levels from the high to the low of the correction, and these are the levels that result. Now, how to interpret these levels? If you see after a correction like this, a stock or an index exceed the 78.6 level, what that means is you're going to get a retest of the highs 9 times out of 10. Now, if you get a close below this 38.2 level, what that usually means is a retest of the lows. Again, 9 times out of 10. We're never dealing with certainties in trading and analysis of charts. We're dealing with probabilities, but these probabilities are good probabilities. Now, as I said, the S&P has been chopping in between these two levels, which has made it a difficult market to trade, okay, because the trend has been very uncertain. It's really been a very sideways, choppy market. That is until this week. Now, I had expected the S&P was probably going to rally up and retest these highs, and the reason I thought that is because that is exactly what the Nasdaq did. Now this is a chart of the Triple Q, the Power Shares Triple Q Trust, which is the largest ETF that tracks the Nasdaq. And here we've got the high, we've got the correction and the bounce here, and you can see that within a couple of weeks the Nasdaq had closed above this 78.6 level, which tells us a retest of the highs is on the cards. And that's exactly what happened. We pretty much kissed the high there, little sell-off, and then exceeded the highs. Now, given the leadership we've seen from the tech sector and the Nasdaq, I thought that the Nasdaq was probably going to drag the rest of the S&P up with it. But seems my optimism was misplaced, because look what's happened. We've hit this level again, closed below it, and we've just had a string of red bearish candles ever since. Now, what happened Thursday and Friday? We've had two strong down days. Thursday closed below the 38.2 level, and so did Friday, well below it. So the highest probability now is a retest of this February low. And what happens when we get to this level is pretty significant, okay? Because if we get a solid close below this February low, we could then enter a phase of the market for the next few weeks or months where the dominant trend is lower, and we're going to make more money from shorting stocks than we are from going long. Okay, so we're going to have to change our game plan. That hasn't happened yet, but we're probably going to get a pretty strong signal this week. So we've got pretty bearish pattern here on the S&P 500, and it's kind of hard to put too positive a spin on the price action that we're seeing. The one positive you could come up with is that the S&P 500 is now sitting on its 200-day moving average, which could act as support. It did act as support back here in early February. However, the negatives are a close below this 38.2 Fibonacci retracement level, and the fact that we've got a pretty bearish red candle here. There's a candlestick in Japanese candlestick charting called a Marubozu candle. Marubozu, I believe, means shaved head in Japanese. And this is a candle with no wicks, where it opens on its high and closes on its low. Now, this isn't a perfect Marubozu because there is a small wick there. But generally, when you get a big red candle like this that closes on its lows, that is not the final low. Usually there are more lows to follow. Now if we look at the weekly chart of the S&P 500, it actually looks even worse. Okay, you can see the solid close below the 38.2 level, and this here is a really good Marubozu candle. It's opened on its high, it's closed on its low for the week. Okay, so this generally means you're going to get at least a couple of weeks, at least 1 week, where there is a lower low than this one the index reaches. Okay, so I think the bearish arguments here are certainly stronger than the bullish arguments. Same goes for the Nasdaq, which has been as strong as an ox. We've got a close very close here to the 38.2, but I just think given the weakness in the broader market is likely to drag the Nasdaq down with it. So what's gone on with the Nasdaq? Well, I'm kind of going to blame Facebook here, because even here in mid-March when the Nasdaq was reaching new all-time highs, and I did talk about this in a couple of blog posts, Facebook wasn't. Okay, Facebook was unable to reach new highs and really even unable to take out this high here. Maybe somebody knew about the news that was going to break. I don't know. But clearly Facebook has kind of given up the ghost here. And what's a little bit concerning about Facebook right now is this level here, it's as low as it's been since, look at that, mid-July last year. So anybody who's bought Facebook stock within the last 8.5 months is now underwater. And what you're going to find will happen is that anybody who owns Facebook who's bought it in the last 8.5 months, if it rallies, they're going to look at their Facebook position and think, you know what, maybe now is my chance to get out. I don't like the news. I don't like this data breach. I don't like the fact that people like Elon Musk are removing their Facebook pages. This story broke that Elon Musk has removed Tesla's and SpaceX's Facebook pages after a Twitter campaign. This is not helpful for sentiment, okay? And people are going to read things like that and look for excuses to get out of their Facebook stock. Now, Facebook has been such a huge performer, and it's a big stock, okay? Its market cap is nearly $500 billion, so it's going to be a top holding for a lot of hedge funds, a lot of pension funds, and a lot of institutional money. And when it starts underperforming, they're going to look to jettison their holdings whenever they can. So I think a lot of stale bulls are going to keep a lid on the Facebook stock price for a while, and that is going to really impact sentiment towards the Nasdaq and the tech sector. So it's not great news. In case you weren't aware, there has been a hashtag delete Facebook campaign on Twitter. As far as I can tell, it was started by one of the founders of WhatsApp. WhatsApp is the instant messaging application that sold themselves to Facebook for billions of dollars a few years ago. So that clearly not helping sentiment towards Facebook. But let's go back to the SPY and let's have a bit of a look at what's been going on under the hood here. Let's start with the financials, okay? Because the financials, this is one sector that really looked as though it might have been able to join tech and dragging the S&P 500 to new highs. Well, financials have been a bloodbath the last couple of days. And in fact, look at this. It's pretty much back down at the February lows, okay? So we've got a retest on in the financial sector already, okay, those February lows. If we look at basic materials, that's already below the February lows, okay? So that's reasonably bearish. If we look at in the industrial sector, it's not there yet, but I'm betting that the test is on. Tech sector has pretty much mirrored the Nasdaq, but again, very close to closing below the 38.2 level, which again would argue for a retest of these lows. Now, consumer staples, this has been a really weak sector, and that's blown below the February lows, okay? Now, consumer staples stocks, the sector is a sector that usually performs poorly when inflation is high and interest rates are rising. This is because if you're a consumer staples stock, inflation is bad for your profit margins because your input costs tend to rise more quickly than you can pass them on. So inflation tends to be bad for profit margins, which causes consumer staple stocks to underperform. Now, this weakness we've seen in consumer staples, this looks to me like the market is factoring in a period of higher inflation and higher interest rate rises, okay? And we know that the Fed is of a mind to increase rates. They increased rates last week. We know that there are some nascent signs of inflation, and this market action tells me that the market is discounting this for the longer term. Okay, so that's not great news. Real estate sector has been weak. Okay, real estate sector is pretty much a bond play, as are the utilities. These sectors tend to perform well when bonds are performing well. They tend to perform poorly when bonds are performing poorly. Healthcare sector not looking great either. You can see there's a test of the February lows happening right there now. And then consumer discretionary, again, this sector looks pretty weak. Marubozu candle there. Okay, we're not back at the February lows, but we're probably heading there. If we just draw the Fib levels here, you can see that is another close below this key 38.2 level. So we're probably heading back down here, I would say. Now bear in mind, consumer discretionary includes stocks like Amazon and Netflix, which has just been juggernauts. They've been so powerful. Without them, this sector would already be back down there, I'm pretty certain. And energy sector, look, this has been weak the last couple of days, but that's probably just more of a factor of general market weakness, because oil has actually been trading pretty well. You look at oil and it's broken out of this wedge formation to the upside, and oil looks like it wants to go higher. So I think once the dust settles on the market, we've got a better clue on market direction, we can probably start looking for some long trades in the energy sector. Let's have a quick look at the transports as well. Transports have been weak. Again, we got a close there below the 38.2. Transports are often seen as a bit of a first mover. When economic times are improving, goods get shipped more often, more shipping of goods takes place, and it's generally a positive sign of the consumer, and obviously the converse is true when things start to slow down. So looks like the trannies are starting to price in an economic slowdown there. On the bonds, this is a chart of the US long bond, the 30-year bond. We're in a downtrend, okay? Lower highs and lower lows. We're well below the 200-day moving average. And normally when you see a risk-off move like we've seen in equities the last 2 days, big sell-off in the stock market, you see a money moving into bonds. You see a rally in the bond market. And look, that just hasn't happened. All right, this is very anemic price action. Usually what happens is you get an allocation out of risk assets like stocks and into riskless assets or low risk assets like bonds, and that's not happening. And this is what concerns me for people who are in traditional diversified buy and hold portfolios. Equities look expensive, bonds look expensive, real estate looks expensive, and when everything looks expensive at the same time, there's kind of nowhere to hide, and everything sells off together, which is kind of what we're seeing. So if you are in a traditional, conventional wisdom, buy and hold type diversified portfolio, learn how to trade. Learn how to short stocks. Learn how to trade with a plan. It's the only thing that's going to save you. Now this is the chart that has got a lot of people pretty excited about the end of the bond bull market. You can see here that US long bonds have broken a pretty significant support level, which does argue for further weakness. Weakness in bonds, of course, means higher interest rates, which is an economic headwind. Gold. Gold actually surged higher last week. Gold often can attract risk-off flows. Now, if gold can take out this resistance level here and take out the previous highs that we saw in January and February, I think we enter a buy the dip sort of environment in gold. Gold could move up for the next few weeks. The other things that cause me to feel a little bit cautious, dollar yen in the FX market. Dollar yen has been very, very weak. What this means is the US dollar is weak and Japanese yen is strong. Now Japanese yen, it's another risk-off asset. Japanese yen generally only rallies when risk is being taken off. And if you look at this chart, we're not really anywhere near any support for dollar yen yet. So this thing looks like it could go a fair bit lower. And if dollar yen is selling off, it is going to be hard for equities to rally. Mirror image of that is Aussie dollar. Now Aussie dollar obviously rallied into that January high, and ever since the January high in the stock market, it's been selling off. We've got lower highs and lower lows. Aussie dollar is trending lower. Aussie dollar is a risk-on currency, and again, when Aussie dollar is selling off, that is just a good coincident indicator that risk is being taken off, which is an unfriendly environment for equities. So I think that the arguments against equities certainly outweigh the arguments for equities just here. Look, I get it. Earnings are really strong. The economy's strong. The US economy, world economy all look good. But the thing is that the market is discounting in the future here, not the present. Okay, and what the market is potentially saying is maybe things are as good as they're going to get. Okay, we've got unemployment which is at 4% in the US. That's effectively full employment. Maybe that starts to get worse from here. Maybe interest rates keep going up. Maybe inflation keeps going up. Maybe the environment becomes more hostile for equities. Now, we don't know any of this for sure, but like I said at the beginning of this video, if we get a solid close below here, below these February lows, then I think the trend, or the path of least resistance will be lower, okay? I don't know how long that trend will last. It could be weeks, it could be months. I'm not saying that this is the all-time high for the stock market and we're about to enter a bear market. No, I'm not saying that. But what I am saying is that we could enter a prolonged period of lower highs and lower lows. It could go on for weeks or months. It doesn't mean the bull market is completely over, but it does mean that for the next little while, you're going to make more money from shorting stocks than you are from buying them. So it's something that we need to watch. And like I said, we're probably going to get a pretty good clue on this week. Now, the market could have a bit of a wipeout tomorrow and then bounce and then rally. And then we might find that we're still stuck in this range. Hopefully, we're not stuck in this range for too much longer. I would like to see the market take out this low or this high so that we can get clearer about market direction. So what should traders be doing in this sort of environment? Well, my first tip is cut your position size. Okay, don't put on as much risk. My second recommendation is don't try and catch every move. All right, if you're trying to catch every move and you're going long here and you're going short here and then you're going long here again, you're going to get chopped up. All right, so really only take 10 out of 10 setups. Don't take any marginal setups. Now, in this sort of environment, if you've got good solid long positions, yeah, they're going to fluctuate, okay? They're going to increase in value when the market rallies and they're going to decrease in value when the market falls. But as long as you're diligent about moving your stops and hitting your profit targets and taking profit, you can still absolutely make money in this sort of market environment. But we're probably going to have to be happy with a higher number of smaller wins, okay? If we're still in this sort of range, we're not going to be looking for runners, okay? We're going to be looking to probably hit first profit targets, maybe second profit targets, but our profit targets are going to be smaller. Stops are probably going to be a little bit wider, but we're only going to be taking the very best setups that we can find. Now, I'm not really seeing too many setups today that really grab me, okay? Something else that I wanted to point out, these propulsion trades that I scan for, the bearish propulsion trades are stocks that are making 52-week lows, and there are 58 of those today. Bullish propulsion trades are stocks that are making 52-week highs, and there are none. Okay, so there is a shift in the market dynamic there. There are a lot more stocks making 52-week lows than there are 52-week highs. In fact, there are no stocks making 52-week highs, which makes sense in the context of the sell-off that we've seen. But look, there are really very few stocks that, I don't see myself placing any orders for Monday night. Some of the stocks that I'm keeping an eye on, big sort of market leaders, things like Netflix. Netflix has seen a bit of a pullback. So Netflix is really strong uptrend, a bit of a pullback here. This is one that I'll be keeping an eye on. Progressive Corporation, another one, beautiful uptrend, bit of a pullback. Again, this is one that I'll be keeping an eye on. ServiceNow is another one that kind of catches my eye. Again, beautiful uptrend there, bit of a pullback. Again, I don't feel compelled to do anything Monday night. But these are the sorts of things I'm going to be keeping an eye on. Shopify, been a great stock for me. Small pullback here. Again, I'll be keeping an eye on names like that. Keysight Technology was another one that I sort of thought was worth a bit of a look. Another one I'll be keeping an eye on this week. In terms of my current open positions, I don't have very many long positions on at the moment. I'm still long Flight Centre in the Aussie market. I got long just here. Reached my first profit target, and you can see it really looks like it's put in a double top there, so I would fully expect to get taken out of the rest of my position at a profit on a stop loss on Monday. That would suit me quite well. I'm still short CVS, which is a consumer staples stock. This was a propulsion trade that I got involved in here. That's working quite well. Mid-America Apartments, that's another short trade that's I got involved in just recently that's working out quite well. I will be looking to put some risk on, but really only in the very best trades. They're really focusing on trades that tick all of the boxes and leaving the marginal trades well alone until we get some clearer signals. Anyway, that's about all I had to say for this week. I hope that helps. I hope it gives you some perspective, and I wish you all good trading. Thank you.